Welcome to Lesson 3 of Module 5, How to Develop a Personal Investment Plan. So in this lesson, we're going to look at what are the steps you need to take to develop a plan for getting started investing that's relevant and specific to you. The quote for this lesson is from Noel Whittaker. Now, Noel Whittaker is coined as Australia's financial Wizard of Oz. He is a worldwide authority on personal finance, and he's written something like 22 books on the topic of personal finance. So he is well educated and versed on the issue of personal finance. So his quote is, "I guarantee those who put an investment plan in place will have a lot more money when they come to retire than those who never got around to it." So despite the fact that you may feel fearful of getting started investing, the truth of the matter is that those that make a conscious effort to start moving beyond living paycheck to paycheck and focus on just affording their existence essentially, for those that take the next steps and actively look at how they can build their savings and their investments and put a plan in place to achieve that, will naturally fare better come retirement. But why do you need a plan, you might say? Why is it that I need to plan this entrance into the investing world out? Well, regardless of whether you consider yourself an active or a passive investor, before you make a start with investing, you do need a plan. You need this. To do this, you need to look at what you want to achieve and what type of investments you need to make to achieve this. So this is a step-by-step investment planning strategy. So these 7 steps will help you develop your personalized plan. And they are, first and foremost, revisit your goals. Why are you investing? Second, look at the time horizon attached to each of those goals. Then identify your appetite for risk. Think about your personal investment style, which is what we talked about in the last lesson. Then it comes down to the tricky part, selecting your actual investments. Knowing the costs associated with those investments is the next step in the plan. And then the last part is really just about your mindset going forward. Focus on the plan and not the market. It's one of the hardest things to do, but it is essentially one of the core aspects of managing your portfolio well. So for the purposes of this exercise of building out a personal investment plan, we're going to use the example of Jenny and Steve, who are 31 and 33, with their 2 kids who are 4 and 2. It really helps to just use a real example of a couple who are at the same life stage as you, potentially, who have their goals, and will show you how it is they go about developing a personal or applying these steps to develop a personal investment plan for themselves. So step 1 was revisiting your goals. So Jenny and Steve have the following financial goals for their family. They have a short-term goal of upgrading the family car. They have a medium-term goal of providing private schooling for their 2 kids. And they have a long-term goal of funding a comfortable retirement. So those are their top 3 financial goals. The next step in the step-by-step plan is to look at the time horizon. So in the case of Jenny and Steve, they have the following time frames for each of their goals. They want to upgrade the family car in the next 2 years. They want to send their 2 kids to school in the next 8 to 10 years based on their ages now. And they want to be able to retire comfortably at 65, which is roughly 30 years away. The next step is to identify your appetite for risk. So in the case of Jenny and Steve, they feel differently about risk when it comes to investing. So Jenny is a balanced investor, which means she has a medium level tolerance to risk, and she's prepared to accept some volatility in their investments in the short term. Whereas Steve, on the other hand, is an aggressive investor, and he is prepared to accept a higher level of risk to pursue greater long-term returns. So it's really important to develop your investment plan together as a couple for this reason. So in cases where there's a difference between the couple in regards to their tolerance for risk, it makes sense to discuss the differences thoroughly, because ultimately your risk profile will determine what kind of investments you place and ultimately what kind of returns you can expect on your money over the long term. So a cautious approach may be to proceed with a strategy that's best suited to the person who is more risk averse. So in this case, based on Jenny's risk profile, if the investments are to be placed as joint investments. The next step is to think about your personal investment style. So Jenny and Steve are both busy parents. Steve works full-time outside the home and Jenny's a stay-at-home mum and works in her own small business on the side. They have no real investing experience and they're relatively new to investing. They've never made any investments on their own before. They identify, therefore, with a more passive investment approach. Okay, step 5 was to select your investments. So this is where most people get really caught up. There's many different companies, investment types, and a lot of things to consider. So your selection is based on consideration of the first 4 steps: your goals, your time frame, your attitude to risk, and your investment style. So let's go through selection of investments for each of their individual goals. So for Jenny and Steve, their first goal was to upgrade the family car in the next 2 years. So given the short time frame of this goal, they should be looking at cash investments as an example, with the following features. They're low risk, so they can be sure their capital's preserved and easily accessible within the 2-year time frame. There's little to no volatility, so they're very low risk that the value of their funds will fall, and they can expect an estimated return of 2 to 3% on that kind of asset class or investment type. So for their second goal, which they outlined, which was to fund private school fees for their 2 kids in roughly 8 to 10 years' time, this is considered to be a medium-term goal, given their time frame is in excess of 7 years. So their time frame's unlikely to move forward, given the goal is education-based and a child can't commence high school before a certain age. So it's a pretty fixed time frame. And they will have sufficient time invested in the market to recover any short-term periods of negative returns, which might cause their investments to fall. So based on that, they could consider more growth-orientated investment options. So as such, they should look at investing across a diversified portfolio of shares, managed funds or index funds with the following features. A low to medium level risk, so their capital is less secure than when funds are invested in cash and their investment could fall in value over the short term. But as I mentioned, they have sufficient time, given an 8 to 10 year time frame, invested in the market to recover any short-term periods of negative returns or loss. Those kinds of investments would have a medium level volatility, so their capital value is likely to fluctuate, so go up and down in value over the short term. And they could expect an estimated return of 6 to 7% on a portfolio of that size and nature. And then looking at their third goal, which was retire comfortably at age 65, which based on their existing or current ages is roughly 30 years away. So this is considered a longer term goal, given the time frame is in excess of 10 years. Now, in order to save for a comfortable retirement, the average investor would need to achieve a much higher rate of return on average than that which is achievable simply by saving surplus funds in a savings account or even a term deposit, unless of course they were starting significantly early in their working life. They will have sufficient time invested in the market to recover any short-term periods of negative returns, which could cause their balances to fall in value. So they could consider, given the significant length of time, a high growth orientated investment option that has the potential to provide long-term returns much higher than a bank account. So as a result, they could be looking at investing across a diversified portfolio again of shares, managed funds or index funds with an aggressive focus on growth. And so that kind of portfolio or investment would have the following features. It would be higher risk, so it will likely mean negative returns on the value of their portfolio in 4 to 5 years out of a 20-year time frame. So they still need to be comfortable with some level of risk. The portfolio or the investment for that particular goal would have higher volatility. So the capital value of what they invest is likely to fluctuate significantly in value over the short to medium term. So go up and down again. And they could expect over that time frame a return of anywhere from 8 to 9%. And that is purely a guideline. It could be much more than that over the life of that goal time frame horizon, which is 30 years. So that is just an expectation. Now, even though we've gone through that in a lot of detail, it's still likely to leave you feeling a little bit like, I'm not sure I quite understood all of that. Now, the reality of the situation is when it comes to selecting investments is that there are 2,400 individual companies listed on the Australian Stock Exchange. And in addition, there are 10,000 or over 10,000 managed funds that are on the Morningstar investment database. So the point of those numbers is just to articulate or demonstrate to you that there are a significant number of investment options out there when it comes to picking the individual investments you make. And that really is where the benefit of an advisor comes in, to helping you work out what it is you should be investing in that lines up with each of those goals, those expected returns, and those time frames that you have set for yourself, because it is quite a big task to do that on your own as an inexperienced advisor or someone who has not done it before. But that is to show you those previous slides, the approach one would take to doing it if they were to do it on their own. Doing it on your own without any guidance or advice, however, is a little bit complex. Now, number 6 would be to know the costs, because cost is the single biggest predictor of future investment returns. This is because it's the only thing you can be certain about. So in order to maximize the performance of any investments you make, you need to be able to know what commissions are payable to the parties involved, and know the fees and charges of individual investment options. Because all costs, even small ones, spread over time reduce the return on your money. So you need to be aware of the various fees associated with the individual investments you make, so that you can factor in how these impact your overall returns. And lastly, the last step was to focus on the plan, not on the market. And again, that's a mindset thing. So financial markets and economic conditions can change rapidly. Volatility, which is simply the fluctuation in the value of an investment or market as a whole, is inevitable. And it's an inevitable characteristic of investing in the share market. But it's the nature of markets to move up and down over the short term, and trying to time the market over the short term is extremely difficult. If you have built your investment strategy with careful planning and advice, and the investment is long term, then stay with it. Jumping in and out of the market as a reaction to short-term volatility will greatly affect your return over the long term. So people then still have this natural fear, but what if the share market falls? If you watch the news in the morning, they always have a report on how the Dow or the ASX performed. It's on all of the news media stations, whether you're online, people are posting things about it on social media all the time. So what if the share market falls? Well, it will. And that's one thing you can count on. Because share markets, like life, have their ups and downs. The world is an uncertain place, I like to say, and there's the risk of war, recessions, oil price hikes. But if history is a guide, the stock market will be the best place to invest for the long term. And as a long-term investor, you can expect to see periods where the share market moves sideways as well as downwards. And at times the movements may be sharp, but over the longer term, history shows an upward trend and an increase in value. So the key takeaway to remember is that the share market is cyclical, which is why you invest over the long term. Over the long term, investing into the share market shows an increase in value or an upwards trend. And it's important to remember that there are financial risks involved in investing and also in not investing, which we discussed earlier. And those are the risks of inflation, the risks of longevity, so that you may outlive your money. And that is a really important consideration in today's day and age, given that advances in medical and health technology mean we're living so much longer. So there are financial risks to investing, but there are also risks to not investing. Okay, so the activity associated with this lesson is a checklist. I want you to download the checklist for creating your investment plan. So use it below to work through the steps that we've just gone through to create your own personal investment plan, or at least a framework for doing so. Now, if there are any knowledge gaps or things you're unaware of, then at least you will know where it is that you need to focus in order to get that together for yourself. Okay, next up, our final lesson on getting started with investing is how to open your first investment account. Once you've understood the basics, you've understood your personal investment style, and you've created the backbone or the outline for a personal investment plan, the next step is how do you open your first investment account? So join me in lesson 4. I'll see you there.